Okay, problem 10-14. We are talking about a comprehensive variance analysis. Miller Toy Company manufactures a plastic swimming pool and at its Westwood plant. The plant has been experiencing problems as shown by its June co- contribution format income statement. Janet Dunn, who has been appointed the general manager of the Westwood plant, has been given instructions to quote unquote get things under control. Upon reviewing the plant's income statement, Ms. Dunn has concluded that the major problem lies within the variable cost of goods sold. She has been provided with the following standard cost per swimming pool, which is listed below. During June, the plant produced 15,000 swimming pools and incurred the following costs: purchased materials of 60,000 pounds at $1.95 per pound, used 49,200 pounds in materials in production. We're going to ignore finished goods and work in process. Worked 11,800 direct labor hours at a cost of $7 per hour. Incurred variable manufacturing overhead totaling $18,290 a month for this month. A total of 5,900 machine hours were recorded. So, it's the company's policy to close all these variances to cost of goods sold on a monthly basis. So they put all of these into cost of goods sold. Compute the following variances. So in order to really figure out what's going on, we're going to have to compute variances. So we're going to have to compute the direct materials price variance and quantity variance, the direct labor rate and efficiency variance, and variable overhead rate and efficiency variance. Because as you can see in the contribution format, actual right here is variable cost of goods sold is 196 when we planned 180. And that is the only difference. So we should have made $36,000 in net operating income, but we really only had 19,710. So Ms. Dunn, it's obvious since this is the only column with a variance that variable cost of goods sold is problematic. It notes at the bottom that it contains direct material, direct labor, and variable manufacturing overhead. That's why we need to go find these variances. Just saying cost of goods sold is off doesn't necessarily point to the actual problem. Is it a problem in the purchasing office? We're not buying at the right price? Is it a problem in efficiency? Is it a problem with machining? Is it a problem with a labor rate? So we need to figure out where our variances are. So this was the standard income statement given in the problem. This was the standard pricing material. So direct materials, they use 3 pounds at $2 a pound, so that standard cost would be $6. Direct labor is 0.8 for $6 and a standard cost of $4.80. Variable manufacturing overhead is 0.4 at $3, so $1.20. So the standard cost for this should be $12, and this is based on machine hours. So given in the problem is that we purchased raw materials, you saw that, 60,000 pounds at $1.95. We used 49,200 pounds, and hours worked were 11,800 hours at $7 a pound. So, step 1. We want to calculate the direct materials price and quantity variances. So the very first thing you want to do is find actual price times actual quantity. And this is for direct materials. I'm going to wrap this text. Then, in order to find both of these variances, we need actual quantity times standard price. And then we need standard price, standard quantity times standard price. Alright. So, and this is for direct materials. So, the actual raw materials purchased were 60,000 pounds at $1.95. if we had used the standard price, we have 60,000 pounds at $2, which was our standard price. And if we use standard quantity and standard price, we would have standard quantity would be 3 times the 15,000 pools times my standard cost. So to calculate a price variance, we would take this column and then we would subtract our actual times our standard price. So this is our price variance. Equals the 17 minus the 120. And since our actual price and actual quantity was less than our actual price, our actual quantity times our standard price, that means that the pricing was different. And that should make sense because we paid $1.95 per pound, but our standard cost says $2 per pound. So it is favorable. All right. Now, to determine if we had a quantity variance, we had 49,200 pounds, right? Pounds. Actual pounds. Right here. Right. And then our standard price is $2. So let's multiply this out. So we have 98,400. But our standard price and quantity should be 90,000. So this is our quantity variance equals the 98,000 minus the 90,000. So our quantity variance resulted in $8,400 more in cost. Is this favorable or unfavorable? It's unfavorable. Okay. And this is called a material quantity variance. And this was a materials, so we're set when we make our list. Price variance. Okay, that was step A. Step B, going back to the problem, says calculate direct labor rate and efficiency variances. Okay, step 1, 2. So let's move on to that. Well, the way that we're going to calculate this, the very first thing is we need actual hours times actual rate. So the direct labor, we're going to take actual hours times actual rate. Then we need actual hours times standard rate. And then we need standard hours times standard rate. And we will wrap it up. All right. So actual hours times actual rate. So actual hours were 11,800 and actual rate was $7 per hour. All right. Actual hours 11,800 times standard rate per hour would have been 70,800 and standard rate times standard hours. Our standard rate is $6 an hour, and to find our standard hours, we need to take the 15,000 pools and multiply it by the direct labor rate here, hours, 6.8, and it should be 72,000. So, to calculate a rate variance, we would take actual hours times actual rate, which is this, less actual hours times standard rate, which equals this. So, actual was more. So we have a labor rate variance of $11,800, unfavorable. Now, let's do efficiency. I can't spell, as we know. Efficiency variance. So how efficient were the workers? So the way we calculate that is we take the actual hours times standard rate plus standard hours times standard rate. So actually we were more efficient than we planned, but the labor costs more per hour than we planned. So total variance equals this plus this, 10,006. So this was a favorable variance. All right, moving on to C. Step C. I should probably highlight this in dark so I know where we are. Step C. Calculate variable overhead, rate, and efficiency variance. Step 1C. All right. So to do variable overhead, we are going to have to do actual hours, because this is based on hours here, times actual rate, and then actual hours times standard rate, and then actual standard rate, standard hours times standard rate. Alright. These full wrap the facts. Okay, so actual variable overhead was given to us in the problem as 18,290. Actual hours were 5,900, and our overhead rate given in the problem is right here. Okay, our overhead rate was right there. And so then our standard hours equals, this is where we have to multiply by the number of pools here, times the standard rate of hours, and then we multiply that by our standard rate of $3. So calculating variable manufacturing overhead rate variance. So this is a rate variance. So we do that by actual hours times actual rate less actual hours times standard rate. So based on the rate, we paid $590 more than we had anticipated. That's unfavorable. Alright. Then we need to calculate variable manufacturing overhead efficiency variance. The way we do that, we take actual hours times standard rate less standard hours times standard rate. Okay. Oops. No, it's fine. So in essence, since standard rate is constant, we are actually figuring out the variance between the actual hours and the standard hours. This would give us an efficiency variance. So actual was less than our standard, so that is a favorable variance. Now let's do total. This was the 590 plus. That is unfavorable. So part 2, we just are going to sum this up. Step 2. Let me make a little summary so that we did all these calculations, but if you try to go back and read all this, I'm not sure you can make an actual comparison. So, material price variance. We found this in step 1. Right here. And I'm just going to get rid of all the negatives. So I'm just going to put these all in absolute value. ABS. Then we need a material quantity variance. ABS. Alright, I scrolled past it somewhere here. Okay. So this was favorable. This was unfavorable. Then we have labor rates variance. That just means absolute value. Labor rate variance. That is unfavorable. Then we have labor efficiency variance. All I'm doing is summing up the results of what we did. And that's favorable. Variable and overhead rate variance. This is unfavorable. And then we have variable overhead efficiency variance. And that was favorable. So our net variance So to calculate our net variance, we are going to add all the favorables and then subtract all the unfavorables. And this is an unfavorable variance, and that makes sense because the variable manufacturing overhead was 196,290. Actual variable cost of goods sold 196 equals, we'll get this from the problem. 196,290 budgeted variable ABS equals 180. Take the difference of these two, and that's what our, this is unfavorable. So what does this all mean? The two most significant variances are materials quantity and the labor rate variance. What could be the reason for materials quantity variance? Well, they could have outdated standards, they could have unskilled workers, poorly adjusted machines, the workers could be careless, they could be poorly trained, or they could have an inferior quality of materials. This is just some of the things that could be causing a material quantity variance, or using too much material. The labor rate variance. Well, we could have outdated standards, which means we just didn't know the labor rate changed, a change in pay scale, or we could be paying overtime. So these are the two most significant. Ms. Dunn should look at that and try to make an adjustment. And this is a comprehensive variance analysis, chapter 10.